Welcome, welcome in to another live, exciting edition of Market Takes. I am Dion Rabouin, reporter at the Wall Street Journal. This is Market Takes. It's our live stream. We're talking all things economy, all things markets, all things that are important with the economy and the financial future of the US and really about the globe. We are doing a very special session today. We are talking about the Federal Reserve's July meeting just concluded. If you were watching, you saw Fed Chair Jerome Powell come out and speak for about an hour answering questions from the media. We are going to break down the speech. We are going to talk about the statement from the Federal Reserve. We're going to talk about the market reaction and what we expect to see from the markets coming forward. We are going to get into all that on today's live stream. So thank you so much for tuning in to Market Takes. Again, look, this was a big meeting for a number of reasons because it's going to tell us a lot about what to expect going forward. The Fed doesn't have another meeting until September, and then after that, they don't have another meeting until November. So we've got a couple months to digest what we heard here today and for the markets to really start to take their marching orders. So we're going to get into all that. It was also important because today was the first time that we have had a full Federal Reserve Board of Governors in 9 years. First time since 2013 that the Board of Governors has been fully filled. So the FOMC was completely full. They were unanimous in what they decided today. We're going to get into all that and what it means as we talk through today. So listen, what I want to talk about, what was the rate decision and what was in the statement. What did we see? What did we hear? What we heard from Fed Chair Powell at the press conference, we're going to get into that. What this means going forward. We were all looking for the pivot today. We were watching for that Powell pivot that, we thought might come up. I'm going to tell you what we saw from that and also what we learned from the market reaction. What was the market's takeaway? That was very nuanced, a lot going on here. We're going to have to jump in between markets, but I'm going to walk you through all of that. So first and foremost, let's talk about the rate decision and the statement. As you know, if you were watching the internet, if you've been on Twitter, if you've been doing anything, the Federal Reserve raised rates by 75 basis points, 0.75 percentage point, as we say here at the Wall Street Journal. That is 3 times the rate that they normally hike at, 3 times the rate that they've been hiking at historically over the past 30 years or so when they start to raise rates. So moving incredibly fast, expeditiously, to quote Fed Chair Jerome Powell in the Fed. It's the term that they've chosen to use about their path going forward. They are hiking rates expeditiously, and they did so again today. Look, I think the most important change to the statement. Now, they release a statement after they make their rate decision at 2 o'clock Eastern time, every time there's a Fed meeting. The most important change, as I read it, was at the very beginning of the statement. The Fed started the statement with, recent indicators of spending and production have softened. Now, why is that important? Let's stop right there real quick. Why is that important? Well, look, the Fed has been pounding the table. Fed Chair Jerome Powell has been pounding the table, saying inflation is our only goal. Inflation is our number one goal. We got to get inflation down. We've got to get back to price stability. These prices going up at 9% is unacceptable. We've got to take that, and that's all we're concentrated on. Well, if that's all you're concentrated on, if that's all you're worried about, why do you start the statement with recent indicators of spending and production have softened? Recent indicators of spending and production have softened is more about the overall level of the economy. If price stability and the rise of prices at 9%, which is what we saw in June, is your number one priority, why are you starting talking about recent indicators of spending and production have softened? That tells us about the economy. That tells us about the potential for recession. That's not about inflation, which you say is your number one, number two, and number 3 priority. So that gives a lot of credence to some of these expectations that the Fed is going to reverse course next year, which we've seen throughout markets. And I'm going to talk to you a little bit more about coming up. We didn't get a summary of economic projections for this meeting. The Fed does those every other meeting, but Fed Chair Jerome Powell in his press conference talked a lot about the June summary of economic projections. He said not much has changed since then, and he said you can look to that as a guide for what we're thinking right now. So definitely something to keep in mind. As you remember, the Fed lowered their growth expectations, increased their inflation expectations, but still kept those a lot lower than where the market sees things. Definitely something to watch there. The biggest thing that's changed since the Fed's last meeting is there are increased worries about stagflation. That's a word that has gotten in the lexicon more and more and more, and economists are worried more and more about it. I want to take just a second to talk about stagflation. What you get in stagflation is the labor market weakens, as in more unemployment, more people losing their jobs, more layoffs. but inflation keeps rising. Inflation stays at a high pace. And that's the most worrisome possibility because it's the worst of all possible worlds. You get more folks out of work so they don't have money to buy things, and at the same time prices are still going up and up and up. And that's become a greater worry as we've moved forward away from 2021 and into 2022 because of what's happening overall in the economy. Right now, consumers have a lot of money, businesses have a lot of money. And when folks have money to keep buying, even as the price goes up, they keep spending. Well, as they keep spending, the price keeps going up. So we've already started to see some signs of layoffs, and we've already started to see some signs of weakness in the labor market. If that continues, we could be in this stagflationary environment, and that is the worst possible outcome. So look, let's get into the press conference and what Fed Chair Powell said and the big takeaways from that. The big picture was that Powell, and this has been a consistent theme we've seen from central banks over the past few months, Powell really started to kind of distance himself from that forward guidance. Remember, the Fed has talked about forward guidance as one of their main tools, one of the most important things that's different now from times past, where they say, hey, this is what we're going to be doing, markets respond, and that's how they're able to tighten up financial conditions to get the outcomes that they want. Well, Fed Chair Jerome Powell today in his press conference really kind of gave it the old, the Drake stiff arm, like, ooh, nah, babe, we don't want that, to forward guidance. Said, well, September, we could see ourselves doing something similar to what we've done the past couple months, but we might not, we might do something different. We're going to be data dependent. Moving back towards that regime of data dependence. Now, we've seen this from Fed Chair Powell today. We saw it from European Central Bank President Christine Lagarde at the ECB's last meeting, saying, quote, we are not offering forward guidance of any kind. That's what Christine Lagarde said at the ECB's last meeting. The Fed has really hyped up forward guidance as a tool in their arsenal, and now they're backtracking away from it as they want to get more towards data dependence, which again suggests that the Fed could be moving towards next year, moving away from rate hikes and towards rate cuts, which is what we've seen the market pricing in. So that's why you saw, I think, some of the reaction that you saw in markets. Before the meeting, Fed Fund futures showing that investors expecting the Fed to raise rates up to about 3.5% by the end of the year, pricing in a reversal of that, rates back down to 2.5% by mid-2023, and even further lower into 2024. But we saw a continuation of that where expectations for rate hikes this year are moving lower, expectations for rate cuts are moving higher. So the market took this meeting saying Powell is looking to maybe do a Powell pivot instead of just raising rates because we've got to get inflation under control, saying, okay, we'll raise rates till the end of the year, and then next year we're moving back down. Now, if you don't get inflation under control, that becomes a problem because, again, you move into this potentially stagflationary environment. I want to read a quote from Bryce Doty. He is the senior portfolio manager at Sid Investments, and he's talking about basically what determines a recession. Fed Chair Powell was asked a number of times during his press conference, do you think we're in a recession? Do you agree with the President Joe Biden coming out saying we're not in a recession, basically looking forward to this GDP number that's going to be released on Thursday, tomorrow, that likely, based on if you're reading the tea leaves here, suggests we're going to see back-to-back quarters of GDP declines, negative GDP growth or GDP contraction, which, technically signals a recession, but it's not a recession until the National Bureau of Economic Research says so. So President Joe Biden getting out and saying, we're not in a recession. It doesn't matter what the GDP folks say. Fed Chair Powell asked a lot about that. He said, no, I don't believe we're in a recession. I want to get to what Bryce Doty, senior portfolio manager at Sid Investments, said. He said, quote, economists have a delusional concept of recession. The population of a country knows the population of a country knows it's when their standard of living is declining. Since April of last year, real wages have turned negative. Workers are going backwards as higher costs outpace wage increases, resulting in a net reduction of what people are able to afford. So even though we've got 3.6% unemployment, even though we've got 400,000 new jobs added a year, people's standard of living is being eroded right now. Wage gains are not keeping up with overall price increases. You're seeing wage gains about 5% and CPI overall inflation at 9%. That means people's standard of living is going down that could be a recession, according to Bryce Doty. I thought that was very interesting. Look, the biggest takeaway from this, I thought, was the market reaction to what the Fed said. And I want to talk a little bit about that right now. You saw across the board really a bullish reaction to this meeting, which, I thought was very interesting. If we look at the stock market, starting out there, the NASDAQ, stocks across the board love this. The S&P 500 finished the day up 2.62%. The NASDAQ finished the day up 4.06%. The Dow finished the day up 1.37%. All that to say, much higher. Now, let's talk about the NASDAQ, up more than 4 points, closing the day up more than 4 points, or more than 4%, way more than 4 points, up more than 4%. That suggests that those risky tech stocks, those tech stocks that need low rates, that don't necessarily have a plan for profitability, that are really premised on growth rather than, how much money they actually make, those took off and soared today. And what that tells you is, again, those expectations for the Fed to back off these rate hikes, for them to lower rates, and that to be what happens in the future. That's what the stock market move today is telling you. And it's backed up really when you look at the commodity market, when we look at the price of oil, up big today. Let's check out oil. I'm on WSJ.com right now. Crude oil up 3.3% on the day. Really everything across the board in the commodity space was up big. You also had copper up big, 2.5%. That was big. And also when you look over at the dollar, the US dollar index was down today pretty significantly. The US dollar index down 0.75% for the day. So when you see the dollar declining, when you see stocks rising, when you see commodity prices rising, that's a bullish reaction to this. And the reason for the bullish reaction is markets want low rates. When rates are low, it's a lot easier to borrow. These things cost less, commodities and the like. And the economy, really businesses are able to take off and charge more and keep those prices high because they're able to just roll over that debt, borrow more, and put more out into the economy. That's right now the thinking in terms of the market. What I don't think the market is grappling with right now is these very real stagflationary risks. And that is if the Fed doesn't get inflation under control and inflation stays high and they have to reverse course because the economy starts to turn over and we get towards a recession, that could be some very bad news across the board. Stocks, bonds, commodities, whatever you're in, it probably isn't going to do well if the US and global economy tanks in the second half of this year or in the first half of next year. And again, the International Monetary Fund, the IMF, warning that they see recession as a more likely possibility just yesterday for the global economy. Here's the other worry about that stagflation. We are starting to see more layoffs. If I've pointed out to you on a couple of these live streams before, the Challenger job cuts report for June showed a 50% increase in layoffs from May. So in June, you saw 50% more layoffs than in May. The initial jobless claims numbers, the last report we got was up 51% from March, from the level that we were at in March. That's a historically large increase for just that short amount of time. And again, the latest components of the ISM manufacturing and services reports, that's purchasing managers index, basically what business owners are saying, the employment components were both contractionary. We're seeing business owners say, yeah, we're, instead of hiring workers, we're cutting workers, we're getting rid of people rather than bringing them on. Even in this environment where it is historically a tight labor market where there are 11 million job openings versus the number of unemployed people out there, we are seeing more businesses say we're cutting jobs, we're getting rid of people rather than that we're hiring people and adding to our employment rolls. That's a worrisome sign when inflation is still at 9%. So the market loved this press conference and this statement from the Fed. The Fed basically saying, we want to keep our options open. We might start to look towards cutting rates again next year. Implicitly, right? That's if you read between the lines. Fed Chair Powell didn't actually say that. Don't put words in my mouth. I won't put words in yours. But that's what the market took from this meeting. And I think it's very interesting that the market isn't really worried about the flip side of that, which is inflation doesn't get back under control and more people start to lose their jobs. So when you look at the board, I thought it was really interesting. The bond market is always where you want to look. And the bond market had some really interesting movement. You saw As Fed Chair Jerome Powell started the press conference, bond yields started to tick down as in prices went up, more people buying bonds. But as he continued, you saw, especially at the back end, the 30-year Treasury just spike up higher to its highs of the day, and it actually finished the day much higher than it did. And that's the longest term that you have. Essentially, longer term yields are factoring in higher potential inflation, maybe higher prices going forward. That's definitely something to watch out for. And you saw really the biggest increases in treasury yields coming at that short end, meaning they expect the Fed to keep doing what it's doing, but maybe things could start to change on the long end. Definitely something worth keeping an eye out for. So what are we looking for in the coming days? I say watch those bond yields. We've seen the 10-year yield come in about 30 basis points from where it was just 5 days ago. In just 5 days, it's down 30 basis points. That's a significant move. Do we see that reverse, or do we see it continue? And we may even see an inversion of the 3-month, 10-year Treasury yield curve, which is the best. The Fed has pointed out it's the best and the #1 predictor of recession. If we see that, that might be cause for some more worries among folks in the market. Watch commodities. Copper is Dr. Copper. It's very moved by what happens in the market and the expectations for the economy. Had a big day today, but a lot of that I think was based on the dollar kind of nosediving and that boosting all commodities. You saw copper, oil, gold, just about everything rise today after that Fed meeting. And Fed speakers to watch for. We have a new Boston Fed president, Susan M. Collins, not to be confused with the senator. Susan M. Collins is new president of the Boston Federal Reserve. New Fed Governor Lisa Cook, we have not heard from her just yet. The new Vice Chair for Supervision, Michael Barr, just sworn in on July 19th. We'd like to hear from him. What does he think about the Fed's pace going forward? And of course, new Fed Governor Philip Jefferson and Vice Chair Lael Brainerd. What they have to say over the next week or so is going to be very interesting in telling us what the Fed path is going to be going forward. They were unanimous today in saying, let's raise rates 75 basis points. I don't think you'll see that same unanimous verdict going forward as things start to get harder, as the questions about reining in inflation versus a potential recession start to get a bit more thorny. And look, that's going to do it here for us on Market Takes. I want to thank everybody that tuned in and watched with us, everyone who joined us on this live stream. And if you're watching this on playback on the YouTube channel, thank you for watching there as well. Please join us. We will be back again. We're taking next week off. I got a big conference I got to be at in Las Vegas. Very important, very serious business. But we will be back again with you in August. Check us out on YouTube on the live stream for Market Takes. All right. I'm Dion Rabouin, reporter at the Wall Street Journal. Thanks again for being with us, and we'll do it again soon.